Central banks are not supposed to panic. They are not supposed to speculate. Their job is to keep the system calm, boring, predictable. So when those same institutions suddenly start hoarding the one asset that outlived every empire, every currency, every crisis, you should stop whatever you are doing and pay attention. Over the last couple of years, central banks around the world quietly bought more than 2,000 tons of gold. Not jewelry, not ETFs, not futures. Physical gold, delivered into vaults, added to official reserves. In 2022, they bought over 1,100 tons, the largest annual haul since records began after World War II. In 2023, they almost did it again, with just over 1,000 tons. In 2 years, they added more gold than some decades combined. Global official reserves now sit near 37,000 tons, and a huge slice of that pile was bought in this short, recent window. This is not a normal adjustment. This is not a small rebalance. This is a historic buying binge by the very same institutions that print and manage paper money. And here's the part almost nobody is telling you. They are not doing this because they like gold again. They are doing it because the world they built on paper promises is starting to crack, and they are preparing for what comes after. The same people who designed the game are quietly changing the pieces, moving wealth from digital entries and government IOUs into a metal that cannot be printed, censored, or frozen by a foreign power. That should terrify you if your savings, your pension, your retirement, your safe assets are all denominated in the same paper they are trying to hedge against. In this video, I'm going to show you exactly what this gold rush by central banks really means, why it is happening now, why 2025 sits right in the danger zone, and how this points to a coming reset of the monetary system. I'll show you the pattern in the data, not just opinions. I'll show you how similar waves of official gold moves preceded the Great Depression reset, the end of the Bretton Woods dollar gold system in 1971, and the stagflation crisis of the 1970s. I'll show you why governments with unpayable debts quietly love inflation and devaluation, and how gold is the tool they use to survive while their citizens pay the price. Most importantly, I'll show you what this kind of reset does to ordinary savers, what survives and what gets wiped out, and the practical steps you can take now before this becomes front page news. Because here's the ugly truth. By the time the headlines say currency crisis, it's already over. The big moves happen in silence, inside vaults and balance sheets, not on TV. The first warning sign is exactly what we're seeing right now. Central banks that once dumped gold in the 1990s when faith in the dollar was absolute are now buying it at the fastest pace in modern history and refusing to sell a single ounce. For decades, gold was mocked as a barbarous relic, a leftover from a primitive age. Central bankers happily told you they didn't need it. Why hold a lump of metal when you can earn yield on government bonds? That was the story, but around 2010, that story changed. One by one, central banks turned from net sellers to net buyers. After the 2008 financial crisis, after the euro crisis, after round of money printing, they looked at their reserves and started quietly swapping some paper claims for physical metal. At first, it was gradual. Then, starting around 2018, the pace picked up. By 2022 and 2023, it went into overdrive. This is not about a fashion trend or a new theory. This is about fear. Fear of inflation they cannot fully control. Fear of sanctions that can freeze reserves with a single announcement. Fear of a debt mountain that can never, ever be repaid honestly. When you look at who is buying, the picture becomes even clearer. China's central bank has been steadily reporting increases to its gold reserves, adding hundreds of tons in just a couple of years, and almost certainly more off the books. Analysts have long suspected that China holds far more gold than it admits, accumulated quietly through state channels to avoid driving prices too high while they are still building their hoard. Russia spent the last decade converting a large share of its reserves into gold, especially after 2014 when sanctions first appeared. After 2022, when hundreds of billions in Russian foreign reserves were frozen overnight, every finance minister in every country outside the US-EU alliance saw exactly how fragile dollar and euro reserves really are. Your reserves are yours until someone in another capital city decides they're not. That single event did more to boost gold's status as a neutral reserve asset than any marketing campaign could have. It told every government, if you want an asset nobody can turn off with a keyboard, you hold gold in your own vaults. Look at the map of recent buyers and you see the same pattern. Emerging economies, countries in the Middle East, parts of Asia, even some in Eastern Europe, all adding gold. Turkey, India, Singapore, Qatar, Poland, and others have announced large purchases, sometimes boosting their reserves by 50% or more in a single year. Even small or politically unstable countries have begun to add gold for the first time in decades. And in the West, something just as important is happening. They're not selling. The US still sits on over 8,000 tons. The big European countries still hold thousands of tons. For years in the 1990s and early 2000s, Western banks happily sold gold into the market at low prices, basically telling the world they considered it unnecessary. That era is over. The big sellers have stopped. Some have quietly brought bars back home from foreign vaults, because in a crisis, you do not want your only real money sitting in someone else's basement on another continent. At the same time, a huge share of the recent buying has been done in the shadows. Official statistics show that a large portion of central bank purchases in 2022 were unreported at the time, meaning they were not declared month by month. Only later did the identity of some buyers appear. This is not how you behave if you just want to diversify politely. This is how you behave if you're trying to build a position without drawing attention, without spiking the price before you are done. Imagine watching a firefighter quietly fill water tanks and check hoses while smiling at the crowd and saying everything is fine. The actions matter more than the words. That is exactly what central banks are doing with gold. And the timing is not random. They are doing this as global debt explodes to levels nobody can repay, as inflation hits highs not seen in decades, as interest rates rise and start breaking things in the banking system, and as tensions between major powers move from trade wars to actual wars. This is not about portfolio theory. This is about survival. So what does this have to do with 2025? Everything. Because all these trends, unpayable debt, stubborn inflation, rising rates, de-dollarization, gold hoarding, are converging into a narrow window in the mid-2020s. Central banks can read the same math you can. They can see that interest payments on government debt are soaring, that political systems are too weak to choose painful austerity, that voters will always prefer money printing today over discipline that hurts now but saves later. They know where this road leads. Devaluation, a slow motion destruction of paper purchasing power dressed up as policy, not crisis. And gold is their seatbelt. They strap themselves in while the car is still moving smoothly at the start of the crash. You, if you're not paying attention, are the passenger without a belt, staring at the speedometer instead of the wall ahead. In the next part, I'm going to zoom in on the numbers behind this buying spree, show you how big it really is compared to history, and explain why the institutions that used to worship the dollar are now quietly voting for gold instead. Let me take you somewhere most people never bother to look: the raw data. Not headlines, not narratives, not political speeches, just numbers. Because numbers don't lie. And once you understand what the numbers are saying, the conclusion becomes almost impossible to deny. The global monetary system is approaching something economists politely call a compression window. That's a technical phrase meaning everything is getting squeezed at once. Debt, currency values, interest rates, fiscal deficits, trade balances, energy constraints, demographic decline. Every major structural pillar is tightening, converging, moving toward a single moment where the system can no longer continue under its old rules. And this isn't theoretical. You can see the pattern forming across continents like storm fronts converging into one violent collision. Start with debt. In 1980, global debt was 30 trillion. Today, it's over 313 trillion. That's more than triple the size of the global economy. No nation has ever grown its way out of a debt burden this large, especially when population growth is slowing and productivity gains have flatlined. But it's not just the size that matters, it's the speed. Debt accumulation is accelerating faster than GDP, faster than revenue, faster than real output. When a system's liabilities grow faster than its ability to generate value, the endpoint is mathematically guaranteed. Something has to give. Either debt gets defaulted on explicitly, or the currency it's denominated in gets devalued. And governments always choose the second option because it hides the pain. It disguises the default as inflation, as if rising prices are some mysterious natural disaster instead of deliberate policy. Now, layer interest rates on top of that. For a decade, the world lived on near zero rates, an artificial paradise created by central banks to mask the cost of rising debt. Zero rates kept the system on life support. Governments could borrow without feeling the pain. Corporations could refinance endlessly. Consumers could chase mortgages and car loans they normally couldn't afford. But when inflation spiked after 2020, the fantasy cracked. Central banks had no choice but to raise rates aggressively to avoid destroying the currency entirely. And in doing so, they triggered the second compression. Because when your debt is record high and your interest rates rise simultaneously, interest payments explode. Governments now spend more servicing debt than building infrastructure, educating children, or defending nations. This is the point where the old system begins to collapse under its own weight. You can see it in Europe. You can see it in Asia. You can see it in the US. The numbers are screaming, and the people in charge know exactly what they mean. Now combine this with a demographic pattern nobody talks about publicly: aging populations. Japan hit this wall first. Europe is hitting it now. The US is trailing by a decade. China is heading there at record speed. Why does this matter? Because economic growth depends on people: workers, consumers, taxpayers, entrepreneurs, builders. When your population ages faster than it replaces itself, your economy slows. When your economy slows, your tax revenue stalls. And when tax revenue stalls while your debt keeps growing, governments face a crisis that cannot be solved with normal tools. You can't tax retirees more. You can't force declining populations to consume more. You can't legislate more workers into existence overnight. So what do governments do when growth disappears but debt keeps climbing? They devalue the currency, quietly, slowly at first, then all at once. Add the fourth compression: energy constraints. This isn't political, it's geological and economic. Transitioning from fossil fuels to renewables requires enormous investment, but governments are already drowning in debt. At the same time, oil discoveries have been declining for decades, and existing wells are becoming more expensive to maintain. This creates energy inflation, which creates general inflation, which pressures central banks to raise rates again, which increases debt servicing costs again, which increases deficits again. Every pathway leads back to the same bottleneck. The system can no longer afford itself. When you put these compressions together, debt acceleration, rising rates, demographic decline, energy constraints, you get a timeline, not a prophecy, not speculation, a mathematical trajectory. Economists at the BIS call it the terminal phase of a debt supercycle. Historians call it the end of a monetary era. Investors call it the moment the rules change. But governments have a simpler name for it: reset. This is where the pattern becomes unavoidable. Every 40 to 50 years, the global financial system undergoes a structural shift because the old framework stops working. In the 1970s, it was the collapse of the Bretton Woods gold peg. Before that, the 1930s revaluation. Before that, the late 1800s shift in gold and silver ratios. We are overdue, and the signals of transition are emerging in the same places they always do: foreign exchange reserves, commodity flows, bond markets, and geopolitical alliances. Look at foreign exchange reserves. Nations are reducing exposure to the US dollar for the first time in 80 years. Not abandoning it, just reducing dependence enough to indicate they see risk ahead. Global central banks are buying gold at the fastest pace ever recorded. Not in retail amounts, but in state-level quantities, tons at a time. That is not a panic. That is preparation, a strategic repositioning ahead of a monetary transformation. Look at bond markets. Yield curves around the world have inverted, one of the strongest recession signals known. But governments keep borrowing anyway because they have no alternative. Inversion means investors believe the future will be worse than the present. But governments are acting as if they can outrun the future with more debt. They can't. The inversion is the market's quiet confession that the old trajectory is over. Look at geopolitics. When financial systems reach the compression phase, nations shift alliances, protect resources, secure commodities, and build alternative payment networks. You see this now with BRICS, with bilateral trade in local currencies, with gold-settled energy contracts. The architecture of a new system is being built in real time while the old system pretends everything is fine. And here's the part people overlook. Monetary resets don't happen when the system is weak. They happen when the system pretends to be strong. Right before the break. Right when everything looks normal on the surface, but the underlying structure is cracking quietly. That's where we are now. The cracks are spreading, but the surface is still intact for the moment. The compression window is closing. When it closes fully, there are only three ways out: default, devaluation, or revaluation. Governments never choose default. They rarely choose open devaluation because it sparks panic. So they choose the sophisticated version, revaluation of strategic assets to devalue liabilities indirectly. It looks responsible. It sounds prudent. It hides the cost in rising asset prices instead of collapsing currencies. And it works every time for them. To understand where we're heading, you need to understand where we've already been, because monetary systems don't evolve randomly. They follow patterns, predictable arcs that repeat across centuries, across empires, across political ideologies. The technology changes, the names change, the institutions change, but the sequence is always the same: expansion, overextension, compression, reset. And every time a government finds itself cornered by debt, demographics, or war, it reaches for the same lever: the currency. Not because it wants to, but because nothing else works. History is a gallery of monetary resets wearing different costumes, but acting out the same script. Start with the one everyone thinks they understand, but almost nobody really does. 1933. The story isn't about gold confiscation. It's about survival. The US was suffocating under the weight of deflation and depression. Prices were collapsing. Banks were failing. Debt burdens were intensifying because dollars were becoming more valuable, not less. When the currency strengthens during a crisis, debt becomes heavier. That's something politicians understood even in the 1930s. A strong currency is lethal when your liabilities outweigh your assets. So Roosevelt pulled the oldest trick in the book. He changed the definition of the dollar, not through legislation, but through decree. And by revaluing gold upward, he devalued the dollar in one surgical stroke. That reset wasn't just a financial event, it was a political one. It transferred purchasing power away from savers and toward the government, which used the relief to rebuild the economy. The public never fully grasped what happened. Most still don't. Fast forward to 1971, the second great reset of the American era. The story most people tell is simple. Nixon temporarily suspended the dollar's convertibility into gold, ending Bretton Woods. But that's the children's version. The adult version is far more calculated. After World War II, the U.S. promised foreign nations they could exchange their dollars for gold at 35 an ounce. It worked, until it didn't. America printed more dollars than it had gold to back them. Foreign nations noticed gold began flowing out of U.S. reserves. Confidence began collapsing. The arithmetic was brutal. If the U.S. kept the gold peg, the gold would disappear completely. If it broke the peg, the dollar would devalue, and America's post-war advantage would end. Nixon chose the option every leader chooses when forced between losing reserves and losing credibility. He sacrificed the currency. He closed the gold window. The dollar devalued. Inflation exploded. Debt got cheaper. And the government survived. Then look at 1985 and 1987. The Plaza and Louvre Accords. These weren't full resets, but mini resets disguised as international cooperation. The US dollar had become too strong, crushing US exports and threatening recession. So the US, Japan, France, the UK, and West Germany coordinated a controlled devaluation of the dollar. They disguised it as diplomacy, but the objective was simple: weaken the dollar to alleviate economic pressure. It was a reset of exchange rates through collective action. The world accepted it because the narrative was soothing. Coordination, stability, balance. Underneath the language, it was currency manipulation at the highest level. Now consider 1998, when the global financial system nearly collapsed because a single hedge fund, LTCM, used leverage to amplify tiny market imbalances. The Federal Reserve didn't frame what they did next as a reset, but that's exactly what it was. They orchestrated a bailout disguised as a private sector rescue and injected liquidity through the banking system to prevent contagion. They effectively rewired market pricing, redefining risk and reward through policy intervention. When the private sector fails, the government steps in. When the government steps in, the currency absorbs the cost. Quietly, invisibly, inevitably. Then came 2008, the closest modern analog to what's coming. Mortgages collapsed. Banks imploded. Markets froze. Instead of letting the system cleanse itself through defaults, which would have destroyed the banking sector, the government and the Federal Reserve created trillions of dollars and injected them into the system to absorb the losses. They didn't call it money printing. They called it quantitative easing. They didn't call it devaluation. They called it policy accommodation. But the mechanics were the same ones used in 1933, 1971, 1985, and every crisis before. Shift the burden from institutions to the currency. Spread the losses across every dollar holder, dilute purchasing power to protect the system. People think 2008 was a bailout. It wasn't. It was a currency reset disguised as financial stabilization. And then you reach 2020, the event that accelerated everything. Lockdowns froze economies. Governments had to fill the void. The US printed over $5 trillion in 18 months. Nearly 80% of all dollars in existence today were created after 2008. That's not a statistic, that's a warning. A currency cannot expand at that pace without consequence. But governments had no alternative. They were boxed in by decades of unsolved problems. Stagnant wages, high debt, slowing demographics, fragile supply chains, political polarization. They did what governments always do under pressure. They used the currency as the relief valve. And that single decision triggered the inflation spike that now traps the Federal Reserve between two catastrophes. Preserve the currency by raising rates and risk breaking the system, or preserve the system by cutting rates and risk breaking the currency. This is the exact point where historical cycles converge. The system has reached the stage where the old tools no longer work. You can't lower rates because inflation is unstable. You can't raise rates because debt is too high. You can't shrink deficits because the public would revolt. You can't expand deficits because bond markets are strained. You can't return to the old gold peg without revaluing reserves. You can't maintain the current dollar strength without suffocating the economy. Every door leads to consequences that threaten political stability. And this is where governments throughout history have always reached for the same hidden lever: hard asset revaluation. When currencies decay, when debt becomes unmanageable, when public trust fractures, the state turns to assets it controls: gold, commodities, reserves, and changes their pricing structure, not through markets, but through policy. That's what 1933 was. That's what 1971 was. That's what the Plaza Accord was. And that's what 2027 is shaping up to be. But here's what makes this time different. For the first time in history, governments don't just have gold to revalue. They have digital assets. They have a new monetary instrument with no historical ceiling, Bitcoin. And just like gold in 1933, Bitcoin in the 2020s is moving from a speculative asset to a strategic reserve. Not because governments want it to, but because they need it to. Because without a new pillar to revalue, the reset math doesn't work. History isn't repeating this time. It's evolving. The old pattern is merging with the new technology. And what comes next is not a gold reset or a digital reset, but a hybrid reset that connects both. Every monetary reset has a trigger point, a moment when pressure stops building quietly and starts breaking things publicly. For the US and the global financial system, that moment is forming right now, 2025 into 2026. Not because of politics, not because of ideology, not because of a single event, but because every structural force that held the system together for the last 50 years is reversing simultaneously. You can feel the tension everywhere: in the bond market, in the fiscal deficits, in foreign reserve flows, in corporate financing, in the energy markets, even in geopolitics. Each one by itself could be managed, but together they form an uncontainable convergence that no central bank can sterilize, no treasury can outmaneuver, and no narrative can disguise. Start with the most dangerous line on the American balance sheet: interest payments. This is the number that quietly determines the entire trajectory of the country. In 2000, US interest payments were $223 billion. Whereas in 2010, they were $414 billion. In 2020, $523 billion. But by 2024, they crossed $1 trillion, and they are projected to reach $1.4, $1.8 trillion by 2027 if rates remain anywhere near their current range. That means interest, just interest, not program spending, will exceed the defense budget, the Medicaid budget, the federal education budget, and every discretionary program combined. This is the point where a government loses control of its fiscal narrative, not because it wants to, but because mathematics makes the decisions for it. At this stage, the Treasury faces a paradox. To stop interest costs from exploding, interest rates need to fall. But to stop inflation from exploding, interest rates need to stay high. The government needs the dollar strong to attract foreign buyers of bonds, but it needs the dollar weak to make the debt affordable in real terms. These are mutually exclusive demands. You cannot satisfy them at the same time. And once a monetary system enters this kind of contradiction, something has to break. Now look at the bond market itself. For decades, US Treasuries were the safest asset in the world. That changed in 2023-2024 when long-term Treasuries suffered losses worse than the 2008 stock market crash. Not because of default risk, but because the system is fundamentally mispriced. Investors finally understood that inflation isn't an anomaly, it's policy. And when inflation becomes structural, long-term bonds become toxic. Foreign demand for Treasuries has been weakening for years, but in the last few cycles, the decline accelerated. Central banks that once bought US debt by the hundreds of billions are now reducing exposure, buying gold instead, or diversifying into commodities and regional trade agreements. This creates the next pressure point. Who funds US deficits? If foreign governments won't, and if domestic banks are stretched, the only entity left is the Federal Reserve. But if the Fed prints to buy treasuries, inflation rises. And if inflation rises, the Fed has to raise rates. But raising rates increases interest costs. And increased interest costs force the Fed to print more to absorb the deficit. This is the doom loop the system is quietly entering. It's not hypothetical, it's arithmetic. Next, consider the political dimension. When governments hit the debt wall, fiscal restraint becomes impossible. Nobody wins elections by cutting benefits or raising taxes. That means deficits will grow, not shrink. And entitlement spending, Social Security, Medicare, will balloon as the population ages. The trust funds that support these programs are projected to run dry early in the 2030s. That timeline compresses political decision-making into the next decade, turning financial necessity into political crisis. But no politician will campaign on, we need to cut benefits by 30%, or we need to raise taxes across the board. They will choose the only tool that doesn't require voter permission: the currency. Then there's the third pressure point: global fractures. When the world trusted the US dollar as the anchor of stability, the US could run deficits without consequence. But today, geopolitical alliances are shifting. Nations want redundancy, not dependence. Payment networks are being built outside of SWIFT. Commodities are being priced in alternative currencies. Trade is moving into regional blocks. None of these changes destroy the dollar, but they weaken its monopoly. And when a reserve currency loses monopoly power, its issuer loses the ability to export inflation without consequence. The inflation comes home. Now consider the corporate side of the pressure. The US economy has relied for 2 decades on cheap borrowing to fuel expansion. Tech boomed on cheap capital. Housing surged on cheap mortgages. Companies rolled over debt when it matured instead of paying it down. But with rates staying higher for longer, refinancing becomes a trap. Over $1 trillion in corporate debt rolls over in 2025-2026 at interest rates 2 to 3 times higher than the original loans. Margins compress, layoffs spike, investment slows, and recessionary pressure builds. When corporations tighten, tax receipts fall. When tax receipts fall while interest costs rise, deficits explode further. This is where cycles collide, and you haven't even factored in energy yet. The world is transitioning to new systems without the infrastructure to support them. Underinvestment in oil has created supply fragility, while renewable deployment is not yet stable enough to replace it. Energy inflation becomes general inflation. General inflation becomes political instability. Political instability becomes monetary intervention. It's all connected, and the connections are tightening. This is why 2025-2026 is the breaking point, not a collapse, not chaos, but the moment the system's contradictions exceed its ability to disguise them. The point where confidence turns. The point where the debt, the currency, the rates, and the politics collide. And when confidence breaks, resets begin. Not with an announcement, not with a speech, but with a policy pivot that seems necessary, critical, stabilizing. Every reset in history emerged from a pressure point like this. And every time, governments reach the same conclusion. Hard assets must rise so debt can fall. The public sees rising gold prices. They see rising commodity prices. They see rising digital asset prices. They think it's speculation, but it isn't. It's the silent beginning of revaluation. When a monetary reset finally arrives, it never looks like a collapse. Not at first. It looks like a policy decision, a stabilization measure, a coordinated effort to restore confidence and strengthen the financial system. That's how resets always begin, wrapped in reassurance, framed as necessary, sold as responsible. But underneath the language, the mechanism is always the same. The currency is quietly sacrificed to save the system built on top of it. And when that moment comes, and it will, the world won't end. Stores will stay open. Banks will function. Markets will trade. Life will continue. But the underlying value that supports everything you own, everything you've saved, everything denominated in dollars will begin to shift. Gradually at first, then rapidly, then irreversibly. Here's how the reset unfolds. Not in theory, but in the sequence history always follows. First comes the justification. A crisis, fiscal, geopolitical, or market-driven, creates a sense of urgency. Bond yields spike, deficits rise, inflation refuses to fall, or a major financial institution shows signs of strain. Politicians step in and declare that extraordinary times require extraordinary measures. They talk about stability, about safeguarding the economy, about protecting families and retirees. They never talk about the real objective, reducing the government's debt burden without openly defaulting. Then comes the narrative shift. Suddenly, national conversations focus on financial resilience, strategic reserves, modernizing the monetary system, leveraging digital assets, strengthening the dollar's credibility. These phrases sound technical, even boring, but beneath them is preparation for the real move, revaluing the assets the government already owns. Next comes the policy pivot, a new reserve framework, a reclassification of gold or strategic assets, a digital reserve standard, a new form of backing. It won't be announced as a revaluation. It will be announced as modernization. And overnight, the price of the assets the government controls, gold, strategic commodities, and yes, Bitcoin, will be assigned a new official valuation. Higher, much higher. Not because the market demanded it, but because the system required it. This is the reset, not a crash, not chaos, a repricing, a silent rewriting of the relationship between the currency and the real assets beneath it. And when the repricing happens, the effect on everyday life will be seismic. Prices will rise, not slowly, not gently. They will jump. Food, energy, housing, insurance, transportation, everything priced in dollars will recalibrate to the new value of the currency. The government will say it's temporary. They will say supply chains are adjusting. They will say corporate greed is to blame. But the truth is simpler. When the currency loses value, everything priced in that currency rises. Savings will evaporate, not instantly, but steadily. A $50,000 savings account that once represented stability may only purchase what $20,000 once did. Fixed incomes will fall behind rising costs. Bond portfolios will lose value in real terms. Pension promises will strain under inflation. Anyone holding dollar-denominated assets will absorb the cost of the reset. But here's the part most people overlook. Resets don't destroy everyone. They reassign value, they redistribute wealth, they push the burden onto one group and reward another. The ones who suffer in a reset are always the same. People who save in cash, people who hold long-term bonds, people who assume the system will protect them, people who trust the currency more than the assets behind it. But the ones who endure, who preserve purchasing power, who come out stronger, are also always the same. Those who own scarce assets, those who hold real stores of value, those who diversify before the reset, not after. Those who understand that monetary shifts don't reward intelligence. They reward positioning. Gold will not save you because it is glamorous. It will save you because it cannot be printed. Bitcoin will not save you because it is trendy. It will save you because it cannot be diluted. Productive real estate, commodities, energy assets, these won't protect you because they're fashionable. They will protect you because they are real in a world where everything else is being redefined. But repositioning during a reset is too late. Once the revaluation occurs, once the currency shifts beneath your feet, once prices begin recalibrating, the window to move closes. Hard assets rise faster than salaries, faster than bank transfers, faster than decisions. Resets reward the prepared and punish the reactive. And that's why understanding what's coming is not enough. You must act before the pivot, not after it. This isn't fear-mongering, it's pattern recognition. The same pattern that played out in 1933, in 1971, after 2008, after 2020. The same pattern is playing out now across central banks, bond markets, reserve flows, and geopolitical alliances. You are living through the opening chapters of the next monetary era. Most people will ignore it. Most people will dismiss the signs. Most people will wake up one day and wonder why their savings don't stretch, why their bills keep rising, why their retirement projections suddenly look impossible. But you are not most people. You're here. You're paying attention. You're seeing the shift before it's announced. Now, I need you to do one thing. If you want to stay ahead of the reset, not the headlines, not the commentary, not the political noise, but the actual mechanics and signals as they unfold, then don't just watch this passively. Join the channel. Subscribe, turn on notifications. Because the next 2 years are going to move fast. Policies will shift quietly. Markets will react violently. Narratives will change overnight. And if you're not following this in real time, you will miss the moment when positioning becomes possible. And after that moment passes, you don't get a second chance. So if you want the updates, the breakdowns, the real analysis, not the sanitized versions, hit subscribe right now and I'll see you in the next video.